Hi, I'm Charlie Jamieson, Chief Investment Officer in Jamieson Coote Bonds, and this is a review of markets in July 2024. July has been a fascinating month. We've clearly seen very strong negative correlations from fixed income markets as we continue to see economic data the world over decaying. We've seen that in the US data throughout the month of July. And finally, to finish the month, a much more moderated inflation number coming in for Australia, which will guarantee that the RBA are very likely to stay on hold for the foreseeable future before moving to a cutting cycle similar to their global counterparts, which we've already witnessed across, the Canada have cut twice, the ECB have cut. It's fully expected that the Bank of England will also be joining the cutting party. The Federal Reserve in the United States are also expected to cut interest rates in September. And so that non-stimulatory rate cutting cycle, which we've been talking to all year, looks to be in full swing now. And that's because the realised inflation outcomes in most of those G7 markets are coming in much closer to mandate, allowing central banks to lower interest rates, which is obviously providing good support for fixed income assets. The danger here, though, is that on waiting for data dependency, there is a danger that growth may slow too much. And this is the problem with the modelling that was used so heavily prior to the COVID experience. And now central bankers being very cautious about relying on those models again. Ordinarily in the cycle, as growth is slowing, policy would be adjusted in expectation that prices will moderate fairly quickly in line with slowing growth. Waiting for that realisation of slowing prices does endanger the fact that growth can stall too much. And that can certainly cause more volatility in markets. And we've certainly experienced that in the very early part of August, with a number of factors coming together, with a rate rise in Japan on a completely different cycle, combined with much weaker data in the United States, and the rotation out of very tech-heavy allocations and a recalibration about expectations on things like AI. And that's caused immense volatility in markets, which we have to believe will continue in the near future, certainly as we run up into the US election come November. It does seem to us that the RBA, will also be joining the party. We certainly wouldn't rule out rate cuts by the end of the year. They are very adamant that they don't want to do that. We've heard these types of statements from them previously. There weren't going to be any rate rises until 2024, only a few years ago, and yet here we are with a cash rate at 4.35%. If they do hike again, I think it's almost irrelevant for the bond market. The bond market would rally right through that episode. It would be deemed as a bridge too far. We've seen markets like that respond already. Just last week, the Bank of Japan hiked interest rates. It was a 50-50 probability type meeting, and the Japanese market has done nothing but rally since that surprise rate hike. What is obvious and evident sometimes is not the way that these things play out, and that does bear thinking through, particularly as these volatilities have been tremendously intense in currency markets, in rates markets, and certainly in some equity markets of late. Those volatilities often don't stay in sub-asset classes and certainly have the ability to skip asset classes at times. And that probably means that our near-term, go forward, whilst the economic data is okay, it's not fantastic, it's certainly not nearly as shiny as it was, but it's hardly dire just yet. Doesn't mean markets can't have these bouts of pretty severe indigestion. And certainly after a period of real certainty, I guess, amongst investors, they've been very, very certain about the no landing outcome. A decline and a loss of momentum in US data is certainly giving a few folks something to think about with their own asset allocations. Interestingly, as I said, that negative correlation between government bonds and things like equities has been very, very evident through these episodes. We've also noticed the beginning of an underperformance in credit spreads. And that's something that I think will gain a lot more traction and a lot more focus from the market as we come towards the end of the year. As we said, bond returns have been pretty healthy. Global bond returns have been outperforming that of Australian domestic returns to this point. We do expect that Australia will catch up. Certainly where the rest of the world goes, we absolutely believe Australia will follow. We will not, we've had a reluctance for our own inflation to come down and follow the rest of the G7. We were very slow to get going in inflation, and anyone that's seen us present, this type of timeline, it's very evident to see that Australia was slow for inflation to begin. It's slow in achieving that last mile type outcome, but certainly the RBA have extended the runway with their own tolerance for how long that might take, and that's why we feel it's very unlikely that they'll hike rates again. But it will be data dependent, and we'll have to see how things materialise as we come through the third quarter and look towards that US election, which is a clear inflection point for markets that will require a lot of thought as we get closer. Thank you very much.